Hello, and welcome back to the Very Real Estate Effect podcast, a show dedicated to real estate investing right here in Quebec. Today, we're joined by Mike Wolf. Hi, Mike.
Hey, good to see you, Axel. Thanks for having me.
Hey, it's a pleasure, man. So, I've been looking forward to having you. So, a lot of people may not know you in town, even though you grew up in Montreal in Dollars des Ormeaux, if I'm not mistaken.
Absolutely.
And you've moved across the country, and now you invest in Calgary and in the US. And you are a lifestyle entrepreneur, a real estate investor, a speaker, and you've had a very successful career over the last 30 years in real estate.
Yes, that would be true. It's been a definitely an adventure, that's for sure, but a good one.
Yeah, yeah. Well, it seems like it, and especially now you were just mentioning that you're actually in Puerto Vallarta, so not so bad of a current location.
Yeah, I escaped from Canada. I actually normally before COVID I was a nomad. Uh, COVID hit. I thought, well, the safest place for me to be is back in Canada, so I went back to be with my daughter and grandkids. And I was okay till the snow started to fly, but then I said I can't do winter. I haven't done winter in like 7 years, so I hopped a flight to Mexico and been here ever since. So
Good choice, my friend. Good choice. So let's jump right into it. You were in Alberta, and then you started to invest into the US, and it's a move that we see a lot more here as prices in Canada have become astronomical. A lot more people are turning to the US market, but obviously for us Canadians there is a number of aspects that people not may not be familiar with when it comes to how transactions are held, the tax situation, and so on and so forth. And I was hoping that we could kind of go through your history of transactions a little bit and kind of get address some of those topics.
absolutely, yeah, there are definitely some similarities between investing in Canada and the US, and there's definitely some differences. And for the most part, I'd say, as somebody who's done both countries, I'd say most of investing in the US is advantageous, but there's
Hmm.
obviously some certain things we need to protect ourselves with, and definitely need to deal with things like the tax consequences and things like that, or else we get ourselves in trouble. But I'm happy to dispel some of the myths and explain some of the ways to deal with some of these things.
Perfect. All right. Well, look, let's start with a very basic situation. Let's say tomorrow morning I woke up and said, hey, you know what? I want to go buy a small multifamily property somewhere into the US. Let's pick Illinois or yeah, Illinois, wherever. And I want to do all this at a distance. So obviously, I would need to build a team. How would you suggest going about that?
Yeah, well, one of the challenges when you try to invest remotely, and it's even a challenge when you try to invest close to home, is getting that dream team of yours. Because as you probably know, if you've been in this industry more than about 3 days, you know that getting the right people can be a challenge, and getting contractors to show up is difficult when it's on a home next door to you. Imagine what happens when you're going to a different country where you can't really check up on them. So yes, you definitely want to have teams. One of the things that I recommend is, instead of starting from scratch, go try to find somebody else's already built team. And I'm not here to sell my stuff, but like for example, I sell turnkey properties in Atlanta. We've already bought them, we've already fixed them, we already have the team in place. So there's numerous turnkey providers out there that already have the teams. But once again, be careful, because not all teams are created equal. If you were going to go do your own thing, and hopefully the borders open up soon, and it becomes possible to hop on flights and still be able to get back home. If you are trying to build your own team, the good news is we live in a really great age in terms of information online, etc. And so I'd go recommend, hey, go join some meetup groups. And if I was going to go to, let's say, Chicago, if you're picking Illinois, I'd go join some Facebook groups and meetup groups of real estate investors in that area. And what I find is the most successful investors, they tend to be abundance minded, and they're happy to share with you. They're not going to say, oh, well, if you use my roofer, he won't be there for me. Unless you're fixing roofs every single day, there's enough work there's enough to go around. And so number one, we have access to a lot of information. We can read reviews on people. And then the other thing is that I find that A players hang out with other A players. If you find a really good property manager, they're not going to refer you to a really crappy
Yeah.
contractor, etc. And so good people are connected to other good people. So sometimes you only need to find one or two kind of players on your team, and they can kind of fill in the rest of the blanks for you. And so it's a little bit easier than you think. But once again, be careful, because there is also a lot of crap out there. And especially when we get into tough times. Like I remember back 2008 when the big recession hit, everybody and their dog was desperate for money, and there were a lot of scams going on. And I think we may see some of that reoccurring as COVID eases up and a lot of people have lost their jobs, so people get more desperate. So be careful and use common sense, and definitely take advantage of the fact that we can connect with other investors and compare notes and read
For
reviews.
sure. Yeah. And it's interesting you mentioned that, because contractors are so hard to reach now. Like whenever you actually find one, like I always wonder, like, something wrong with him if he's available.
Exactly. I know it's a double-edged sword. On the one hand, you want somebody who's free, but then you're wondering, well, why are they free?
Yeah.
So the good news is, like for somebody like myself, I've been investing in the US for around 15 years, and I have my teams that we use over and over and over again. So we're not constantly looking for new people. And so, once you getting started right now is actually a little bit difficult because everybody's so busy and the markets are so hot.
Yeah.
But the good news is it's not always like that. And I don't think these current trends are going to continue that much longer, to be honest. So.
Okay, so now we've kind of built somewhat of a team. Let's say we have a good real estate agent. We've been recommended by one or two local A-class investors. Now it's time to actually go look for properties. Like, would you recommend someone just looking for off-market deals, or just looking on the MLS? How do you go about it?
Yeah, so much like in Canada, that's going to depend a lot on what strategy you want to do. And so if you were going to buy and hold, you're going to look for a much different avenue than if you're looking to be a flipper or a wholesaler. So these strategies will kind of dictate where you're looking, how you're looking. So if I was going to buy and hold, for example, you have to be really careful what market. Just like in Canada, you got to pick the right market. Most people by default invest close to home, and that sometimes leads us down a not very good path. For example, there's a lot of states in the US where there's rent controls, and there's a lot of state, and same with Canada, of course, too. And there's a lot where there isn't. There's places. One of the reasons I picked Atlanta. Well, I'll just really quickly tell you how I pick a buy and hold market, just really quickly.
Sure.
First, I'm going to look for a place that is landlord friendly. And so if you go to California, that's one of the most unlandlord friendly places. It's very tenant friendly. And if you get a bad tenant, they can stay in your home for over a year, not making a payment. And if they know how to work the system, and they all know how to work the system, by the way, they know how to work the system, they can live in your home for free for a long, long time.
Yeah.
And I got news for you. The bank never once will call you up and say, hey, I hear you got a bad tenant. You don't have to pay us. Whenever your tenant pays, just give us a call. They never
let
do
us
that.
know.
Yeah, exactly. So it's pretty tough to be in a negative cash flow situation for years straight for most people.
Yeah.
And that will do you in. So you want to go to places that are landlord friendly. I love Atlanta. We can usually get rid of a bad tenant in 3 weeks or less. And
wow.
Yes. So it's very, very, very business friendly, very landlord friendly. So that's number one. Number two thing I look for, what are the chances of appreciation? And that's where we create wealth. A lot of people, they kind of forget about that part. They go straight for the third thing, which I'll talk about in a second. So it's very important to see where am I going to buy a property where maybe I'm, and I'll use Atlanta numbers. The homes there that start around $80,000 or $90,000 in good neighborhoods. And so where's a place where this $80,000 or $90,000 home is going to be $150,000 or $200,000 or $300,000 home 5 years from now? And so how you figure that out is supply and demand. And especially right now with what's happened with COVID and the global shutdown of the economy, people are going to be looking, especially in the US, people are going to be looking for work, and they're going to be looking for a low cost of living. And that's where they're going to be moving to, much more so than Canadians. Canadians, we tend to stay put. Americans will move in search of work. I mean, I see people leaving in droves from California right now. People are leaving in droves from places like Manhattan. Mm-hmm. So imagine, before COVID, you were in your $5,000 a month, 1-bedroom apartment in Manhattan, and you had your job. It was potentially, that was a sustainable lifestyle for you. Maybe you enjoyed it. But now, if you lost your job in this last year and a half, that $5,000 a month is a lot of money. And that for most people is not sustainable unless you have the same amount of income you did before. And so a lot of people are going to have no choice but to leave. And where are they going to go? They're going to go where the jobs are being created, and they're going to go where the cost of living is low and they can get ahead again. And so once again, I'll use Atlanta because I'm very familiar with it. The government is very business friendly there, and they offer a lot of tax incentives to corporations to set up there. So it's head office to Coca-Cola, Turner Broadcasting, Home Depot, Delta Airlines. So not only does it have a lot of businesses, but they're very diverse industries, meaning that right now, obviously the airlines are struggling. So Delta has laid off a bunch of people. But guess what? Those people can go work for Coca-Cola or Home Depot, or now actually Microsoft just announced that they're creating a hub in Atlanta, bringing in 9,000 jobs. And so, so that's the number two thing. Where is that home that I buy today going to be worth a lot more in 2 years from now, 5 years from now, 10 years from now? Because if we can get growth, that allows us to use the BRRRR method to pull some money out of that to buy more properties or sell the property and once again build our portfolio without having to keep going to a job and saving down payments. So that's number two. The third thing, and most people make the mistake of looking at this first and ignoring the first two, is they look at strictly, hey, what are my cash on cash returns going to be? Yeah. And quite often that leads them to the 1% rule, which takes them to places. I'll pick on Detroit because I invested there and that was a huge mistake. So you want to look at those things in that order. You want to have first security. You want to preserve your capital. So security comes from being in a market where the government is on your side and where we can actually do business safely. Yeah. Number two thing we look at is scalability, and scalability comes from properties appreciating. And then the third thing is sustainability, and that's being able to have cash flow coming in so you can afford to hold on to that property. If the market goes bad, you still have positive cash flow coming in and you're safe and you can weather the storm. And so, but anyway, that's a long way of saying if you're going to buy and hold, you need to look at those things. But if you're looking to flip, you can look at pretty much any market. If you're going to be a wholesaler, you can look at any market as long as there's at least a certain amount of demand, a certain size to the city. So really you need to know your strategy. On the other hand, one of my favorite strategies, and you mentioned it at the beginning, I specialize in tax liens and deeds. There's certain, and for those who don't know what that is, when people haven't paid their property taxes in a number of years, the county needs that money in order to pay for their hospitals and their police and their roads, etc. And so eventually they have to put these homes on the auction block. And I've seen some of my students pick up single family homes for $7,000 that were worth 90, 100, 110,000. And so there's auctions that take place all over the country, but my favorite place to do that happens to be in Texas. And so once again, depending on your strategy, you're going to pick the market based on what it is you're looking to do. And quite often people make the mistake of thinking, oh, I heard Atlanta's a great market. Well, it's a great market for buying
for certain things. Yeah.
For certain things. And I hear Houston's a great market. Well, it's a great market for certain things. So you need to pick your market based on your strategy.
Absolutely. There's two things I want to unpack here. You mentioned on the cash on cash return and investing in Detroit and how you felt that was a mistake. Can you tell us a little bit more about it? What happened?
Well, here's the thing. So early on in my US career, I thought back in those days, back during the big recession, obviously Detroit got hit really, really bad. And then it's a one industry town. And when it gets hit really, really bad.
Flattened.
And so, anyway, so when you have a whole bunch of people unemployed, when we see these really high numbers, a lot of people, like I said, they go for that number three thing. It's like, what is my cash on cash going to be? I want the 1%.
But there's no appreciation.
Well, there's no appreciation, but even worse, here's what happened. So I bought 3 properties and not next to each other. They were in 3 different parts of town. All 3 of them, I think the most rent I got from any one of those properties was maybe 2 months. Because when you have high unemployment and it's all one industry, if somebody gets laid off, if somebody gets laid off at Ford, they're not going to Chrysler because Chrysler's not hiring either. So you're in a one industry town. There's very high unemployment. The population is shrinking. And so on paper, it looks like the perfect scenario. It's like, hey, you buy a home for 40 grand, it rents for 900 a month. It's like, wow, it's a 2% rule. This is like awesome.
Yeah. On paper, it's the dream property.
Absolutely. In reality, here's what happened though. So I had in all 3 cases, tenants paid for a month or 2, then they stopped. And then you go through the process to evict them, which is lengthy. You finally get rid of them. Your home's vacant for one day. And guess what? Somebody breaks in and steals the copper. And then the next day somebody comes in. I was going to say they steal everything that's not nailed down. They actually steal things that are nailed down too.
Oh, yeah.
And so all 3 of my properties were constantly being vandalized because when people don't have work, what are they going to do to make money? Whatever it takes, they've got to survive. And so unfortunately, and it wasn't just my home. I remember I actually went to go look at a house. And while I was in the house, I actually saw somebody walking out with a hot water tank that they had stolen, that they were stealing a hot water. They were in the process of stealing a hot water tank right in broad daylight. But anyway, so you have to be careful when you're picking these markets because yes, when you have shrinking population, that's the opposite of appreciation. But 2, you're going to get these returns that I call paper returns. They look awesome on paper. You'll never see them materialize. And that's a big mistake I see, especially Canadians make. Because when we're picking south of the border, it's like, oh, I can pay cash in Detroit, if I go to this market, I'm going to have to go and figure out some financing. Well, there's a reason why those markets are so cheap. And even right now during COVID, when most markets are appreciating like crazy and people are fighting over properties, there's markets that are not, they're declining. And the reason for that, these are not the markets you want to be in, but they look really attractive in theory. So you have to be very careful.
And then you also mentioned that your favorite place for the Texas for the liens, sorry, the tax liens. Why Texas?
Yeah, so just to briefly, this is, I actually do a 4-day training, so I can go into a lot of detail if we had time. But there's basically different ways that different counties deal with the situation of delinquent taxpayers. And some of them create something called a tax lien. And what a tax lien is, you're not actually buying a home. You're actually buying what in most cases you're buying what's called a TLC, or tax lien certificate.
Yeah.
And so let's say you're living in, we'll use Chicago again. You're living in Chicago. You get something in the mail from the county saying, hey, your taxes are due on July 1st. And if you don't pay by July 1st, we're assessing a penalty. And I forget what it is in Illinois. I think it might be 24%. So anyway, imagine we'll use 20% just for easy numbers. Your taxes are 1,000. July 1st comes and goes. You don't pay it. And now you owe 1,200 because they added a penalty to it. So unbeknownst to you, they now will create this tax lien certificate and they'll sell it to an investor like myself. And I would pay them $1,000. The county will keep bugging you for payment. And when you finally pay that 1,200, I'm going to get a check in my mailbox for I'll have spent 1,000. I've invested 1,000. I'll have a check for 1,200. So in theory, it sounds really, really good. And it's obviously a lot better than, keeping your money in the bank. However, the challenge with that is you're not getting a home, and most tax liens are very small amount. They tend to be very small amounts of money. So 20% is awesome, but you're making $200 and it's okay. I'd much rather get a house. And so when we go, the opposite of a tax lien is a tax deed. With the tax deed, you're actually buying a property. You go to the auction, you're high bidder, you own that property, you can flip it, you can live in it, you can rent it, do whatever you want with it. Now, if we go to Texas, it's what they call a hybrid state. And it's kind of like if a tax lien and a tax deed made a baby, that's what you get in Texas. And so what I mean by that is that if you're the high bidder on a home, let's say you get a property for $10,000. So you do own that. It is a deed state, but it's called a redeemable deed. And what that means is that the previous owner can come back and buy the home off you. They've got 6 months to do that, but they've got to give you a 25% premium. So if you paid $10,000, they have to give you $12,500 within 6 months. And on top of that, anything that you do to make the property livable or safe, like for instance, if the roof is leaking and you replace the roof, that's another $10,000. So now you're in for $20,000. Well, they've got to give you 25% premium on fixing the roof or replacing carpet or painting. And so you're going to keep track of all your expenses, and you're going to get a 25% premium if they decide to redeem it.
Okay.
So to me, so the worst case scenario is you're going to get 25% premium in 6 months. The even better case scenario is you're going to get the home free and clear. All the mortgages get wiped out, they disappear. So there's a lot more profit in that than a tax lien. You can do a lot of tax liens, but at the same time it takes to do that, I'd rather just go.
No, and you're right. The point isn't to pay someone else's taxes and get a small profit from it. The point is to get your foot in the door to actually take the home.
Exactly. So one of my students, he picked up a property. It was $7,200. The home was worth probably at that time around 90. Now it's worth a lot more. And there's already a tenant in there paying rent. They're paying $900 a month. So he just decided to keep them. And you can do the math. It doesn't take long at $900 a month to get your $7,200 back.
Yeah.
And so it's just
and you own the home right there. It's paid.
Exactly. So it's a very lucrative strategy. Now, I don't want people to think that you just go to the auction, get 100 properties and go retire, because there obviously is competition. And also you need to know what you're doing, which is, like I said, I do a 4-day training because there's so many things that could go wrong. But if you know what you're doing and you do it right, there's a lot of potential profit in it. So, but once again, every state handles it a little differently. I like how Texas handles it, because one, it's a little bit more complicated because they throw that little curveball at you. Oh, well, you know, there's that 6 month waiting redemption period. Now, during that 6 months, by the way, you can rent out the property and get cash flow. In theory, you can flip it. I teach people how to do that. They tell you can't, but there actually are ways around that. You can live in it. But in that 6 month period, the previous homeowner can come back. So because it's a little bit more complicated, it scares away a lot of the competitors, because in this space, you know, the reason most people don't know how to do tax liens and deeds is very few people that are willing to teach you how to do it, because your competition are pretty big institutional investors or hedge funds. their banks. The banks love to do those liens, by the way, because they're taking our money on deposit, giving us almost nothing, and they're able to go turn that into some pretty big profits. So they don't, when you go for to do your RSPs, they don't talk about that stuff. They talk about, oh, well, we have GICs.
Put it in mutual funds, put it in this and that. Oh, it's ridiculous.
Right. So they don't tell you the options that they're doing. They
No.
tell you the options they want you to do. So they have
Exactly.
they can go do that stuff. And so anyway, because it's a little bit more complicated, it keeps the institutional investors away. They just want it really simple. They just want to buy a property, be able to do whatever they want with it, not have any kind of redemption period. So if we're willing to do a little bit more work, we can have a lot less competition and get more home runs. So that's why I love Texas.
And that's what you're describing is a great activity for people who are in Canada and who would want to do that in the US. And, as long as they pick a good state where there's the laws are more friendly towards the investors. But I wanted to go back a little bit at the beginning towards the tax implications, because you mentioned it a few times, and a lot of people aren't aware enough of, for Canadians investing into the US, the taxation is different. So how have you been dealing with it, and what are like some major traps not to fall into?
Yeah, well, first of all, I have to give a disclaimer. I'm not an accountant or lawyer or anything like that. So that's number one. So please confirm everything I say with somebody with the right designation after their name. But I will tell you my experience.
Yeah.
And that's that one is not one size fits all. So I can't just give a blanket statement saying everybody should just set up like this and you're good to go. That's
of course.
Just like if you went to an accountant in Montreal, the accountant's going to ask you a bunch of questions. They're not going to say, oh, well, this is what I do for everybody.
Yeah.
It's like, no, it's very individualized based on how you make your money. So for example, earned income is taxed differently than passive income. So if you're buying and holding properties, that will get taxed differently than if you're flipping.
Mm-hmm.
And if your accountant doesn't even ask you, well, what strategy are you doing? Well, then you need another accountant. And so it's not one size fits all, number one. Number two is that if you set yourself up properly, it's just as easy to invest in the US as it is in Canada, maybe even easier. So some of the big things you need to be aware of is that obviously when you invest in the US, the IRS has no idea who you are. And they don't like that you're potentially taking your profit back to Canada, and they don't know who you are, where you live, what your phone number is. They don't know anything about you.
Yeah.
So they make it difficult for you to do that. Just take your money back without setting something up first. And so at the very basics, you can set up what's called an ITIN number, ITIN, which is, what does it stand for again? I haven't done this in a long time. Anyway, it's your individual taxpayer ID number or something pretty close to that.
Yeah.
So that if you're investing in your personal name, that will allow you to take the money back, because now you're basically voluntarily putting yourself in their tax system. You're saying, hey, my name is Axel, here's where I live, here's my phone number. And now, at tax time, they know how to reach you, so they don't have to withhold that money. Now, if you don't have anything, that's what they're going to do. There's going to be a withholding tax, and they're going to keep some of that money on reserve in their bank account. And then when you file your tax return, they're going to take more than what you would have probably paid in tax. So now you're motivated to go fill out a tax return. And when you fill out the tax return, they'll send you back the balance owing to you.
Yeah.
And so it's just as simple as that. It's filling out a form. And that's if you're buying in your personal name. Now, if you want to get more fancy, there's a whole bunch. There's things called C Corps. There's LLCs, which is limited liability corporations. There's S Corps, which don't apply to Canadians, by the way. So don't try to get one because you can't. And there's limited partnerships. There's a whole bunch of different potential structures that you might set up. And there's sometimes different combinations of them. Sometimes you'll set up a C Corp that controls your LLCs. So I'm just going to give you a few blanket statements of what not to do.
Yeah.
But then after that, you need to have a conversation either with me or with a cross-border accountant or somebody who can kind of give you some direction. And then, like I said, I'm not an accountant. So if you did talk to me, you would go and verify it. But
of course, and this is for entertainment and educational purposes only.
Exactly. This is just my experience. So one of the challenges, and this drives me crazy, is especially before COVID, we'd see these American trainers and mentors coming up and going across Canada and teaching stuff as if they were talking to Americans. And what I mean by that is I've been to many a seminar where they'd say, oh, well, all you need is an LLC and you're good to go.
Worst thing.
LLCs are great for Americans. They're really good because it's a very simple structure. It's basically kind of like in Canada how we set up numbered companies.
Yeah.
It's very simple. It's quick. It's inexpensive, and works great for Americans because it gives you asset protection. Here's the problem though: is an LLC is what's called a pass-through entity, and what that means is an LLC will not pay tax for you. So if all you have is an LLC and your own personal self, An LLC means that, okay, well, the LLC might give you a little bit of asset protection and you're going to put the property in there. But when the property makes you a profit, where does it go to? There's only one place for it to go to, only one thing to tax, and that's you. And so once again, the US doesn't know who you are, so you're still subject to withholding taxes. So it didn't solve that problem, and you still need an ITIN number. Now, C Corp is will pay tax for you, and so that is a solution for some people. The C Corp is, pretty much your typical American corporation is usually going to be a C Corp. Like I said, there's a thing called an S Corp, but that doesn't apply to us. So there's different combinations. And so you can have a C Corp that now controls the LLC. So the LLCs, when they make a profit, the profit flows through the C Corp. But bottom line is there's a solution for everybody, but that solution isn't one size fits all. But don't listen if I'm not an accountant, but those Americans coming across the country are not accountants either.
Yeah.
So if you ever are in a room where they say, just set up a C Corp, I would suggest you run very, very quickly, because they're giving you really bad information as a Canadian, which will lead to you being potentially double taxed and definitely withholding taxes. So when you set up a C Corp, by the way, it gives you what's called an EIN number. And that is basically like an ITIN number, but for a corporation. And if you have that, then you don't necessarily need the ITIN number anymore. But once again, talk to the proper people. They can set you up. And if you're set up properly, doing deals in the US won't be any more complicated than doing them in Canada.
And you bring up a very good point, is surround yourself with experts in the field. Don't try to like read 2 forums online and then just decide what your strategy is going to be. It's a terrible way to do it. And especially when it comes to doing international business, which would be the case for a Canadian investing in the US, you might get slapped with double taxation and you might wipe out your profits of your first year. So do the research, do it properly. And that's one thing I've discovered through many hurdles, is don't be cheap on the lawyers, the accountant, and so on, the notary. Like, they will save you.
Absolutely. Every time you work with a good cross-border accountant, for example, you should look at that. Hey, this is an investment. I'm giving the money, but I'm going to get way more money back because of the investment you made with them. And so having the right people on your team is invaluable. And it's really the only way to do it, because the trial and error way. And that's actually how I started. I'll be honest with you. When I first went to the US, before that, I was only investing in Canada. And a buddy of mine, he moved from Calgary to Las Vegas, and I'd go visit him all the time. And that's when I decided, hey, the opportunity here is amazing. Like, the property kept going up and up. And I thought, man, this is like too good to be true. And I decided I didn't want to miss the opportunity. So I just jumped in, and I ended up paying way more tax than I should have. And I definitely paid more to my bank for exchanging currency. There's a lot of things that I learned as I went. But the good news for people now is that, back when I did it, this was before, I actually started a little bit before the recession kicked in, and there weren't a lot of Canadians doing it. And I didn't even know there was a such thing as a cross-border accounting specialist. I didn't know about some of these things. So the good news for people watching is you don't have to go reinvent the wheel. You can actually talk to people that have already done it, get their advice, and start off on the right foot. I did it the wrong way. I'm glad I did, because I
learned the hard way.
I did it the hard way. But I wish I would have had the resources that time. I didn't, but that's how I got the resources, by doing it. But now I can share with people, so they don't have to go make the same mistakes I did. And it's better to start off doing it properly. And I don't know. I mean, as much as I like the IRS and CRA, I'd rather have that money in my bank account.
For sure. Or give it to your kids, give it to your grandkids, take them on a trip. Yeah,
absolutely. So
as we're wrapping up, you also mentioned that you have a couple of days course on that. Can you tell us a little bit about the program?
Yeah, so I do tax deed trainings. I haven't done it in a little while because obviously during COVID, they've been shut down. And my favorite auction, as I mentioned, takes place in Texas. It's actually in Houston, Texas. And that one's been shut down probably for around 14 months now. So if you consider that on any given month, usually around 500 properties will change hands conservatively. Wow. You multiply that by, let's call it a year, which is also conservative. There's 6,000 properties behind right now. And supposedly the auction is opening up for the first time in 14 months tomorrow with a very small supply of properties. I think they're just kind of testing the waters, and slowly building it up. Once it gets back to full speed ahead, I'm planning on doing another training down there. And we spend 4 days together. The first 2 days are in a classroom, and I teach you exactly what to do, what not to do. And it's also from a Canadian perspective. So I don't just teach you as if you were an American. Most of my clients are Canadian. So I teach you not only how do you do this properly and how do you avoid all the major pitfalls, but I also help you with the taxation stuff. I also help you with converting your currency and raising money if you don't have a whole lot of capital, although you don't need a lot to participate in these auctions. Day 3, we actually go driving around the city, looking at some of the properties that are going to go up on the auction block, and we actually analyze them. In the classroom, we analyze them kind of on paper and look at, hey, which ones make sense. Then as we drive around, some of them that look good on paper are not going to look good when we get there. We're going to eliminate them. Exactly. And we're also going to talk about, hey, well, this is what it would cost. Here's what rehab costs are here in Houston, which are a lot cheaper than Canada, by the way. Both the labor and the materials are much cheaper than in Canada, luckily. So we talk about, okay, well, if we bought it, here's what we'd have to put into it to rehab it. And here's what it could potentially look like. Here's some different exit strategies for it. And then day 4, we actually go as a group to the auction and you're actually in a position where you could potentially bid, because now you know all the steps and you've done all the homework. And then, but here's the best part, is that after you fly back home, you get access. I have boots on the ground in Houston. I have people that will actually go to the auction for you. I got people that can rehab the homes. I've already got a built-in team for you. So you don't have to keep flying back to Texas every month to participate. You can do it right from the comfort of your own home. And I've already done the legwork to build the teams for you.
Nice. I can imagine you're excited for the floodgate to reopen if there's about 6,000 homes behind.
Yeah, they're way behind. And then there's, of course, been a foreclosure moratorium. So then there's all the homes that would have got foreclosed on this year that weren't. So there's going to be so much opportunity there. And so I'm excited because it's been, like I said, it's been over a year now. And we had a false alarm in April. They said they were opening. And then literally 2 days before, they sent me an email saying, no, we changed our mind. And so now, this time, here we are the day before, and so far I haven't got that email canceling it. So I'm very excited to see if it goes through.
Yeah, that's exciting. And so lastly, before we wrap up, where can people find out more about you?
Yeah, so they can email me at info@mikewolfmastery.com. Wolf just like the animal. I've got my website, which is mikewolfmastery.com. And I'd love to give everybody a free ebook on some of the top strategies that are working right now for Canadians who want to invest in the US, some of the best strategies here post-COVID, and even right now, I know a lot of Canadians are still locked down, unfortunately. So this is stuff, a lot of it that you can do from your own home without having to travel anywhere. So I'd love to I'll put it in the chat box so that you have it.
I'll put it in the show notes. It'll be included.
Okay, that'd be great. And then, so it's a free ebook. It talks about some of my favorite strategies. And for anybody who's thinking of getting started in the US, in addition to all the logistics, like figuring out, well, how do you do the taxes? How do you move your currency? How do you move your money back and forth? There's also, well, what strategy do you want to do? And in the US, it's a bigger menu than what we have in Canada. There's more options. We were speaking kind of before we started the show, and about how in Canada we have the Privacy of Information Act, which makes it very difficult. Like, we're trying to get a list of people that are going to foreclosure, very, very difficult. In the US, they have the Freedom of Information Act, which is the exact opposite. Like, everything is public knowledge, it's published. It's super easy to get a list of people in trouble. And so you can help them, like we're talking about these tax deed auctions, but we can actually try to get a hold of these people before the auction, because we have a list of all their names, their address, everything. And we could try to help them out of the pre-foreclosure before they lose it. Then we can go to the auction. If we can't help them before, we go to the auction, pick it up there. And then there's a third strategy that I also teach called overages. And that is, let's say at the auction, a home sells for $10,000 sells for $50,000, and the opening bid was $10,000. Well, the first $10,000, that belongs to the county fair and square. That's the back taxes. That additional $40,000 is called an overage, and that money actually belongs to the previous homeowner. And most homeowners have no idea it's owed to them. And the counties make almost no attempts to try to track them down. Because after after a certain amount of time, there's a statute of limitations. The county gets to keep that. That's their slush fund. They can do whatever they want with it.
Jesus, I thought they would make an attempt and a big effort to reach them and say, like, hey, there's still a balance of $40K we owe you. Very little,
because they don't actually want the homeowner to go collect that money.
Obviously.
So a really cool strategy, and this is great for people that don't have a lot of money, is to go track down these people, say, listen, I know somebody owes you $40,000. If you're willing to split it with me, and you get to decide what that split looks like, it could be 20%, 30, 40. I have a friend that's all she does is overages, and she takes 40%. Her smallest paycheck has been $21,000. And so anyway, so you can make money before the auction, during the auction, after the auction, and all this information is public domain. It's stuff you can get very easily, not like in Canada where you have to go to the courthouse and hang out there all day, and it's just a lot of work.
Yeah.
It's much easier in the US. And so,
Wow.
and that's some of the stuff I talk about in this book, and also at my tax lien training. I call that the trifecta of real estate. And I teach the pre-foreclosure stuff. I teach how do you monetize that auction, and also how do you reunite people with the money that's owed to them after the auction. And that requires almost no money on your part, and it's a great win-win, helping somebody get money that the government would otherwise keep.
For sure.
Very sad, and it's a great win. It's a great win for you and for them. So, so that's some of the stuff that I teach, and it's also in that ebook as well.
Super. Well, I'll put it in the show notes so people can go and download it.
Great. Thank you for that, Axel. Appreciate it.
Hey, Mike, thank you very much. It's been quite interesting. You've been doing this for a while. Clearly, it's not your first rodeo, and it's great that other people can learn from you.
Yeah, thanks again for having me. And if there's anything I can do to help anybody, I'm always happy to help other investors.
Super. Sounds good. Well, thank you very much, Mike, for your participation. And for all of you out there, as usual, if you like the content, please help us continue. Give us a like, subscribe, share it with a friend. It always helps us to get better and better guests. So thank you very much. And I'll talk to you next week. Ciao, ciao.